going to be talking about altitude sickness, market breadth. Markets rallied pretty aggressively off the December lows. JC went through a lot of charts yesterday. I'm going to try to keep it high level, keep it somewhat educational, talk about how we look at market breadth, and then just kind of tie in some of the current market environment charts. So let's get into it. This wouldn't be complete without a disclaimer, so not investment advice, just for informational purposes only. allstarcharts.com/terms, you can find it all there. Table of contents, we're just gonna, walk through some of the traditional indicators, some equally weighted indexes, breadth of momentum studies, and then we're just gonna do an eye test, and we're gonna see, are there more uptrends or downtrends, or are they sideways? Who knows? So executive summary, very data intensive here. So a few main points. One, this stuff is not rocket surgery. You don't have to make it so complicated. As you'll see through the presentation, I kind of keep it simple. There are very few hard and fast rules. So you'll often hear people say, there's a divergence in this indicator, or this is happening. The market's due for a retest, right? We gotta retest those lows, right? All right, cool. Well, the sample size is like 8. So any statisticians out there will tell you, stuff to make decisions based on that small sample size. So I'm going to talk about a lot of tools. I'm sure you guys have different time frames, different processes. So you're not necessarily going to use the same things that I am. I'm not going to use the same thing as you. It doesn't really matter. Whatever works for your process, that's great. And then at the end of the day, market breadth is all about analyzing the market of stocks. All right, section 1, traditional indicators. So JC shared this yesterday. This is the New York Stock Exchange common stock only advanced decline line. Made a new all-time high this week. It's not exactly bearish. This is just one indicator. I believe Andrew Thrasher on Twitter did a great post about how there are mixed results. So sometimes you'll find new highs to be bullish. Sometimes it's bearish. Occasionally you catch a top every once in a while. But really what I want to focus on here is not just taking this chart on its own, but taking it within the context of everything else that's happening. So as you'll see throughout my presentation, it's not just this one indicator that's hitting new highs. It's a bunch of them. So the S&P 500 advanced decline line, again, showed relative strength during this correction and is right back at highs, new all-time highs. It broke out, 4 or 5 weeks ago. The S&P is not even at its all-time high yet. So again, an improvement under the surface. The rally has been relatively strong, and so that's definitely supportive of higher prices. The percentage of stocks above the 200-day, JC shared this yesterday. Again, the signal is not when it hits 15% or gets to an extreme reading. It's when it reverses. And as you can see, we got that reversal, which was a good signal that, hey, that was an extreme, and markets are going to bounce a bit. So value line geometric index. This is pretty simple. Just the average stock in the market. It's an equally weighted index. So we have the 2007 highs, 2015, 2016 highs. It's kind of like regional banks, kind of like broker-dealers and exchanges. As long as we're above those highs, it's tough to be too bearish stocks. So just going to grab some water. Some of the presenters yesterday said, man, it's hard to present at such a high altitude. And I'm just sitting there thinking, man, it's hard to present at any altitude. So this is definitely an adjustment for me, All right, cool. So I know nobody here is trading Indian stocks except Ayush, who came all the way from India. But this is a great example of some of the work we do. So the Nifty 500 stocks, but the 10 largest of them make up 40% of the index. So that's crazy. So next time you're complaining about Amazon being too big, thank God you're not in India, because those 10 stocks are huge. And so they're acting as either a helium balloon on the market or a lead balloon. So if this is in an uptrend, which it currently is, or a sideways trend, I guess you can argue it's a consolidation, it's going to be tough for that index to break down and go lower. So, the direction of these 10 stocks we want to pay attention to. And this is what you kind of get. So the 10 largest stocks are doing great. The Nifty 50 is down 15% off its highs, but under the surface, you're looking at small caps down 30%. So if you're looking to fade strength in India right now, or last month or 2 months ago, you're pretty frustrated if you were shorting the large cap stocks. But the previous chart would have told you, hey, that's probably not the best idea because the largest stocks continue to hold up, the best. So Amazon's a big piece of consumer discretionary. In India, this is the cap-weighted Nifty Energy Index versus the equally weighted. As you can see, they look very different. The cap-weighted index, 60% of it is one company. It's Reliance Industries. So, it's sitting right by its old highs. It can't break out because the rest of the market kind of sucks. But as you can see, for what, almost 3 years, we've been in a downtrend on an equally weighted basis. Just broke down to new lows. So, when people ask me, what do you think of energy in India? I'm like, well, are you asking me about Reliance or the rest of them? Because it's two totally different pictures. So you can do this same exercise for the S&P 500. I did a mystery chart on the blog, 2-3 weeks ago, whatever. Basically put this chart up there, and everyone and their mother was like, "That's the S&P," and I was like, "Yeah, it's not that simple." But the equally weighted 10 largest stocks, it looks exactly like the S&P. But occasionally you get divergences, like in 2015, 2016. So the market's kind of breaking down, right? But the 10 largest stocks are holding up well. And as you can see, they make new highs at the exact same time in earlier in 2018 or October of 2018, whatever that was. They both break down below the January highs at the exact same time. So again, if you're trading a cap-weighted index, it pays to know what the largest stocks are doing. All right, so I'm going to need some audience participation here. We're going to run through these.
Can I ask a question on the last chart?
Yeah, what's up?
I was going to ask, breadth is strong, as you said.
Yep.
So the S&P is coming back rally. The 10 largest stocks, it's only increased a third.
Yeah.
So
Yep.
this is a broad-based rally that is below large cap.
Yeah, exactly.
So what do you think about that? What does that mean?
Yeah, it's a bit of a divergence, right? So, I wish there was a hard and fast rule where I was like, when there's a divergence, this always happens. What we do know is that divergences can't last over the long term. So it's got to resolve itself one way or another. Either the 10 largest stocks are going to catch up and make new highs with the index, or all the other sectors that are hitting new highs on an equally weighted basis are wrong, and they're going to catch down to the week. Yeah, I don't know. I wish I had a better answer for you, but that's kind of the way I look at it.
What do you think? We could go higher or lower from here. Higher or low? Which one? Roll the dice.
All right, cool. As we get through my presentation, you'll also see, there's a lot of range-bound charts out there, so it's not as simple as, up or down. It could go either way. I think we got to weigh the evidence as we get it. So, all right, so I need audience participation here. I'm going to run through the equally weighted sectors, and I need you to stop me if you see a downtrend. Just interrupt me. All right, cool. So technology, largest sector. Not a downtrend. It's not an uptrend either. It's sideways, but not a downtrend. Financials, all right, stuck below support. Not great, but more of a hot mess than a downtrend. Healthcare, trying to break to new highs. Not a downtrend. Consumer discretionary, near flat 200-day. More of a hot mess than anything. Industrial, same thing, right near flat 200-day, but a couple percentage points off its highs. Staples, tried to break down, couldn't do it. Back in the middle of this multi-year range. Energy, all right. Any downtrends out there? This would be like the only one that I could make the argument for, but again, it's more of a hot mess, Yeah, I guess you can make the argument for it, but utilities, I guess if you flip it upside down, it might be a downtrend, but for now, it's an uptrend. Materials, not a downtrend. Real estate, not a downtrend. So if we're seeing none of the sectors in a downtrend, what's going to lead us lower? I don't know. Does that necessarily mean that these all break out to the upside? I'm not sure either. I think, as Todd was alluding to, we got to kind of wait and see. But as JC said yesterday, I'm seeing a lot more stocks break out than break down. So until we start to see that trend reverse, I'm inclined to believe that these are ultimately headed higher. And then when you combine them all, this is the equally weighted S&P, and it looks very similar. Right near flat 200-day, kind of messy. But I also want to point out that all of these sectors hit overbought conditions on this recent rally. So momentum is improving. It's a great sign. Some consolidation would be great. But again, it's tough to make the short case right here. Technology, largest sector in the world, in the U.S. And, the equally weighted versus the cap weighted index just hit a new all-time high. So again, it's broad-based. Equally weighted technology versus the equally weighted S&P 500, new highs. This is the largest sector in the market. Like, if this is making new highs, like, I can't make the bear case, folks. So, I always hear the equally weighted S&P needs to hit new highs, or it needs to be outperforming the cap weighted to for the market to go higher on an absolute basis. And I gotta tell you, nothing can be farther from the truth. I mean, this is just a weekly regression for as much data as I had, and there's nothing there. There's no relationship. So what the equally weighted index really tells you is, hey, when it's outperforming, there might be opportunities that you're missing under the surface because you're not seeing them at the cap weighted level. So I wish it was as simple as, hey, when this leads, we go higher, but it's really not. Great example of this is materials. So the equally weighted versus cap weighted materials index has been, ripping higher since 2009. Is materials the best sector out there on an absolute basis? Anyone tell me? Yeah, it's getting better, but off the 2009 lows, it's probably in the middle of the range, right? So if you owned materials on an outright basis, on an absolute basis, you're a little disappointed. You're like, what the hell is going on here, man? Breath is great, and I'm not making as much money as I should. So again, not go out and buy the XLB, but hey, there's new highs. This is an uptrend, so there's probably some smaller names in the index that you're not paying attention to that maybe you should. So little plug for Koifin here. I know JC and Howard talked about it, but one of the tools I love here is you go to the ETF holdings, and you can sort it by attribution. So when people say this is consumer discretionary, I don't know what it's up to year to date, probably in the mid double digits, like 15% or whatever. But essentially, Amazon is contributing 2% of that. So there's a lot of other stocks in here, like Home Depot, Nike, Lowe's, Starbucks, they're pulling their weight. So not only are we seeing it from an equally weighted basis, like on the chart, if you break it down to the individual components, you can get a much better idea of what's happening under the surface. Sorry, I need a little water break. Man, I gotta exercise more. This is awful. Industry breakdown for the consumer discretionary sector. So you can see, Amazon, yeah, it's a big weight, right? But home improvement retail, restaurants, hotels, footwear, they're all performing well too. So it's not just, Amazon. So next time you hear somebody make that argument, just send them this chart. And this is just for the S&P 500, again, kind of the same view. On the bottom, you have the individual holdings. I sorted by attribution. So actually, Facebook, Microsoft, Apple, and Boeing are contributing the most year to date. Sectors, no surprise that IT is up there. Industry breakdown, diversified banks, those are good. Cool. So just another tool. If you're interested in this kind of stuff, check out Koifin. So breadth of momentum. So we'll start with the basic percentage of 52-week lows on the Russell 3000. That represents, 98 point whatever % of all investable assets in the U.S. So normally what we see at, big lows are these bullish divergences, right? We see new lows in the index, and fewer stocks making new lows. We got that in early 2018, but then in October and December, we didn't see that. We actually saw further deterioration. So that was leading a lot of people, myself included, to think, hey, we're probably going to get a retest. Maybe we undercut these lows a bit, and then we're off to the races with fewer stocks making new lows. But yeah, we haven't gotten there. So does it necessarily mean we have to retest? Again, history would suggest yes, but history also has a sample size of 8 or 9 or whatever it is. So it's tough to make that case. I'd rather not look at this chart and try to make a conclusion based off it. As we'll get into a few of the other charts, these were just very extreme readings. As you can see, 60% of stocks in the Russell 3000 at their December lows hit oversold conditions. So that's a lot of stocks. So to get this bounce is not super surprising. Does that mean we expected it to be this aggressive? No, but it doesn't necessarily mean we need to see a retest either. So just showing we can do the same analysis for sectors or industries. We got energy here. 87% of the index hit a new 52-week low in December. So it's a lot of stocks making new lows. 97% of the index had RSI below 30. So again, these are like very extreme readings. So it's something we want to pay attention to. Financial is a huge weighting in the market. 72% of them hit new 52-week lows. Again, these are very extreme readings. They exceeded what we saw in 2016. They exceeded what we saw earlier in 2018. So, yeah, again, extreme readings worth paying attention to. Doesn't necessarily mean we get this aggressive of a rally, but probably not the place to be pressing shorts either. Yeah, and then 87% of stocks in the financial index were oversold as well. So again, these were the types of readings we're seeing at the end of the month, and part of the reason we got more bullish the first week of January. So looking at the flip side of that, new 52-week highs. The index is a couple percentage points away still, and we're starting to see an uptick, and we're probably around 5-6% or whatever, so nothing to write home about. But again, breadth is improving, stocks are hitting 52-week highs, and the index is nowhere near it. This is more interesting. The percentage of stocks getting above 70 on the RSI, with momentum being in a bullish regime, that actually exceeded any reading we saw in 2018. So, higher prices here than we are currently, but we're seeing, many more stocks seeing improved momentum conditions. So, again, that's a big positive. And then, the best way to look at breadth is just do an eye test, So this is something I do for our India subscribers in our chart book. And basically, the mid-cap chart book, I think, has like 50, 60 stocks in it. And basically, I put uptrend, downtrend, sideways trend, and just get the totals at the bottom. And so I don't expect anyone to know what Indian stocks did over this time period, so I'll just, give you some context. Late October, early November, they started rally, mean revert. So we saw the number of downtrends actually decline, but they were just getting into sideways, right? They weren't becoming uptrends. The number of uptrends has stayed flat through this entire 4-month period. So again, that kind of signaled, hey, this is mean reversion. This is not a change of trend for the mid-cap index or many of its components. And now that the index is rolled back over, it just actually retested its lows. We're seeing the same types of numbers here. 50% of the index is in a downtrend. So is that something we want to be buying? Probably not. All right, one last sip of water, and then I'll finish up here. How am I doing on time? 5 minutes? All right, cool, perfect. So yeah, I was originally going to end this off with going through a bunch of stocks hitting new highs, but that list could go on forever, and quite frankly, I thought it'd be a little obnoxious. So tried to play devil's advocate and say, all right, if I want to be short, let me look through the first 200 stocks in the S&P that have a decent size weighting, and let me see what would potentially lead us lower, right? As you can see, these are the best setups I can find. Dow DuPont, rolling over below a downward sloping 200-day, kind of consolidating here. Momentum hasn't gotten overbought yet. So if we break those lows around 51, yeah, I can make the case for being short. But for now, it's more of a hot mess between 51 and 61. AbbVie, another one, kind of rolling over here, retesting the lows. So if we break that 76 level, sure, I can make a case to be short. But again, like not an A plus short setup by any means. Wells Fargo, for you Head and Shoulders aficionados out there. Is this a retest of a broken neckline? Possibly. Momentum hasn't been overbought in about a year. The 200 days downward sloping. These are all things that are indicative of potentially lower prices. But again, it's kind of range bound here. It's back at levels seen in early 2016, late 2016. Altria, all right, big top here. If we retest this broken support level, the downward sloping 200-day momentum is nowhere near overbought. So again, I can make the case for fading strength if I need to. Gilead, another one, kind of rounding top here, tried to break down with the rest of the market, didn't get there. But again, this doesn't look like an uptrend to me. So if it breaks the recent lows, I guess you can make a case to be short. EOG Resources, similar thing, kind of range bound over the long term, but again, downward sloping 200-day. We're kind of near the lows, so if we get back toward 118, I guess you can fade it. Maybe wait for a break of these lows and then trade it down to 57. But again, momentum not getting overbought below a downward sloping 200-day. Those are the types of conditions that we look for on the short side. And I had 5 or 6 names here out of 200. So if these are your best players, you're probably not winning the game. Sorry, folks. PNC, another one. Again, kind of range bound over the long term. But I guess if you want to fade strength up toward 129, you could do it. Probably not the worst idea. Yeah, that's the last slide. So if you need the slide deck, hit me up.
If you enjoyed this video, I encourage you to take advantage of our Chart Summit discount offer. For just $649, you get 6 months of All-Star Charts premium research. Normally, this is $1679 for the entire year, but this discount gives you complete access for 6 months for only $649. Please visit allstarcharts.com/chartsummit19 and take full advantage of this discount offer. With your membership, you will receive complete access to my entire chart book, which includes almost 1,000 regularly updated charts, the monthly conference call, weekly newsletters, the trade ideas page, and as always, your membership is risk-free. If for whatever reason you decide this is not for you, just email us within 30 days for a full refund. No questions asked. Visit allstarcharts.com/chartsummit19 and please email me once you join and introduce yourself. That's allstarcharts.com/chartsummit19. Thanks for watching.